very kindly joined. You'll hear that the call is recorded. I'm joined by Sarah Koja, who's a partner and the head of the employment group at Clyde & Co. And we think when you're looking at some of these arrangements, there are some important, what I would call adjacent legal issues to be thinking about. So if you're currently thinking about looking at all of your visa and employment relationships with your employees and companies, it's worth at the same time thinking about a few other things. And one of them, of course, is the visa and immigration rules. So Sarah is going to be touching on a few points that we think might be relevant when you're thinking about that are specifically relevant to the type of arrangements we're going to be talking about this morning. And I'm also joined by my colleague, Malcolm Manickshaw, who's a senior director leading our transfer pricing group. There are kind of, again, more adjacent issues relating to transfer pricing that we think are touched on by some of the issues given the sharing of visas and things like that, specifically around maybe the free zones, but also valuation rules, which we'll touch on as we're talking, although most of the content will be the VAT rules themselves. Hopefully you'll be pleased to hear that. Today's agenda, just very quickly, we're going to talk about consideration. And what I mean by that is the valuation of supplies and what is considered to be consideration for making a supply. It's very relevant to this clarification from the FTA. Although it's covering a specific issue, they're actually, in effect, reminding us about how you value supplies. So we'll talk about that a little bit. Then we'll give a quick overview of the clarification itself. We've got a couple of diagrams which hopefully are helpful. Then we'll talk about some comparison with similar rules in KSA and Oman, which are interesting to compare. Then we'll go through a few case studies, including a little bit talking about the wage protection system, which Sarah will cover, which we think is relevant. Then we'll remind ourselves of the conditions that apply for applying for this concession, which in effect this is a concession, I think. And then we'll talk about the valuation rules from a VAT perspective, specifically deeming supplies and open market valuation between parties where one of the parties can't deduct all of the VAT, where Malcolm will also talk about transfer pricing, because there's definitely a connection and some time to be saved by aligning the two things, I think. And then we'll quickly talk about what we think are the next steps for you as a business to think about, and there will be time for questions. If you've got any, please pop them in the chat on Zoom, and we will, if they're complicated, we'll ignore them, and if they're simple, we'll answer them. So hopefully that is a good summary of what we're about to go through. Any other questions, please also feel free to drop them in. And as I said at the beginning, the call's going to be recorded, so hopefully we'll be able to share it so colleagues can listen to this as well if they would like to. So just very quickly, consideration is quite an important concept in the world of VAT, and it's essentially the calculation of the amount upon which VAT should be charged. And the significant thing about consideration is that it is how you calculate the 5%, but you calculate the 5% not just on the money that is received, but also other acceptable forms of payment. So for example, this is why barter transactions are still subject to VAT. If we didn't have that provision, people would just be bartering for everything and there'd be no VAT collected. But importantly, and this is relevant for this discussion, consideration can also extend to situations where payment is received from a third party, but which is contingent upon the supply of your service. So in other words, it's not necessarily just the money that the customer pays you that determines the amount of VAT that must be calculated, but also the payments that that person must make to receive the service from you, which could be to other persons. And obviously in this particular case, that other person might actually be the employee. And what this document from the FTA is reminding us is that where a person has a legal obligation to make a payment, so for example, where I am the visa holder for a particular employee, I have a legal obligation to make sure that that person is paid. That's part of the terms of giving them a visa. Now, in practice, what I might have done is effectively outsource that obligation to another party who is using that person in their business, and they may pay that person direct. However, that person is settling an obligation of mine by paying that employee. Therefore, on face value, that payment, i.e. the salary made direct to the employee, is actually consideration to the person that employs the person. So therefore, potentially VAT is due on it, even though in practice you never receive the money yourself. So it's actually quite a dangerous provision if you don't get your contracts right when you're dealing with third parties in particular, because you can have situations where you've not adequately captured the consideration in your contract, and therefore the FTA may be expecting you to pay VAT on a higher amount than the cash you actually receive from your customer. So this is particularly relevant when dealing with third parties, but obviously it's also theoretically relevant with internal forms of payment, particularly for the purposes of calculating how much VAT to put on your VAT return. And although the concession from the FTA is quite generous, in effect what they're doing is reminding people that the starting point is that VAT is actually due. So if I could just quickly go through what the FTA has basically said. And so what they're talking about is examples which are very common in the UAE, where businesses may share visas. So in other words, a customer has a need for an employee, but doesn't have a visa allocation and is therefore unable to get a person to move to the UAE to work for them or to employ somebody from an existing contract. And therefore, a company, in this case, the one on the left, either the manpower service provider or the visa facilitator, which are the two terms that the FTA used to describe the difference, is the visa holder and actually has the direct legal employment relationship with the person. So in other words, the person's providing their manpower initially to the person on the left, but in practice, they then may be coming under the control and the usage of the customer on the right. The usual position here, regardless of who may pay the salaries, is that the manpower provider in this example would be charging VAT on the services of providing the employee to the customer, and that the FTA would expect that VAT to be charged on all of the costs that are recharged or incurred by the customer, which would include, in effect, the salary, benefits, and other costs that they may pay on behalf of the employee, including healthcare and things like that. And so they have realized that there are people that are confused about this and issued this clarification. In the process of issuing the clarification, they have also given what I think is effectively a generous ruling that allows certain situations to mean that you can avoid paying VAT. And I use the word avoid a little bit lightly there, but you don't have an obligation to account for the VAT on the salary in certain circumstances. Roughly speaking, and we'll talk about these a little bit later as we go through the presentation, that means where the customer and the manpower service provider are part of the same corporate group, and we'll talk about corporate group in a minute, but basically where they're very closely associated with each other. It also means it also applies where the manpower service provider in this example is not in the habit within its normal business of supplying manpower, where the customer is the one that pays and bears the cost of the employment, and where the customer also takes responsibility for that employee, directs their work, supervises them, decides where they work, and the various other things that will be associated with being an employer, even if legally speaking they are employed by the entity on the left-hand side. If all of those conditions are met, then in principle, the salary, benefits, and other costs associated with the employment of that person are not subject to VAT. And that can be, we think, and we'll talk about that a little bit later, whether the customer pays the employee directly or whether the manpower service provider pays the employee and then recharges it to the customer. But we'll talk a little bit about that later, because there's a slight lack of, potentially there could be said to be a slight lack of clarity about that. But because of the wage protection system, we think it's logical that it can be recharged. It's just that the customer must not bear the cost. In other words, it must not be a cost of their business. They must be able to recoup it from the visa facilitator or manpower service provider. And so if all of these conditions apply, then you'll be treated as being a visa facilitation service. And in those circumstances, you are only required to account for VAT on the visa costs, for want of a better word. So in other words, the cost of actually getting the visa, the health checks, and associated related costs. So there is a reduction in the amount of VAT that you have to charge, which could be beneficial if you can't recover all your VAT, but could also be beneficial if this is how you've already done it and haven't realised. So it's actually quite generous from that perspective. But it is important to note, as I say, that I believe that this is a generous interpretation of the rules, and therefore the legal basis for it is essentially the FTA concluding that they will allow this. And so meeting these conditions very precisely is actually quite important in my opinion. So I mentioned earlier that this kind of concession is not uncommon. In fact, there was a concession in the UK for the provision of manpower under secondment arrangements, which was quite similar, although that's been removed subsequently because it was being abused in the UK. And in the region, we have a similar concession in KSA. Actually, I would say that the Saudi Arabian concession is a little bit more generous. So it essentially applies in situations where there's effectively an employment relationship between the recipient business and the employee, and then they allow the payment of the wages to be outside the scope of VAT. There are less conditions attached to that in KSA, so that's quite generous. And in Oman, it's similar, although the Omani rules are sort of buried away in other guidance. So specifically now contained within a piece of guidance on the provision of educational services, where they're referring specifically to the provision of teachers and other educational staff between educational institutions. But the way it is drafted implies that it is their interpretation of the rules more generally, but it is perhaps a little bit to be exercised with a little bit more caution in Oman, and possibly take some advice before concluding it's definitely applicable. But it's interesting that these rules apply essentially across all three countries at the moment. So just a little bit of reiteration here. In a situation where on the left-hand side we have a manpower service provider who is providing employees to a customer, he's not connected perhaps, or it doesn't meet one of the other rules, then VAT will be payable on the entirety of the salary, benefits and other charges, whether they are paid by the customer direct to the member of staff or not. Quite straightforward. In the other example, where the concession conditions are met, then we believe that the FTA would treat the visa facilitation, i.e. the cost of the visa, the health, etc., as being the value of the supply, and VAT is therefore due on that lower amount. If you read the FTA guidance very carefully, there is a little section which refers to the customer must pay the employee, which could be read as meaning that the conditions can only be met where the customer directly pays the employee. However, our understanding of that is not the intention, and the word pay is being used in a broader context and is intended to mean where the customer bears the cost of that person and does not therefore, and the visa facilitator does therefore not pay or bear the cost of that person's salary. And one of the reasons we think that's the case is that because of the wage protection system, in certain circumstances, it would be virtually impossible for you to be in a situation where the customer would actually pay. And this is where I'll bring you in, Sarah, if you could perhaps spend a little bit of a moment explaining WPS to everybody, that would be very helpful.
Yes, of course. So it's actually quite fascinating to listen to Justin talking about how the VAT works and the concession and so on, because my background to all of this is, of course, focused on the employment and immigration aspects. And the key things there really are that the Ministry of HR and the Department of Immigration, which obviously sits within the Ministry of Interior, they are very keen to ensure that, insofar as possible, there is always a direct employment relationship, and that relationship is underpinned by direct payment of wages. And so, and obviously, as we all know, the ministry and immigration, monitor. They monitor visas. They monitor that people are employed correctly, that they're in the country correctly, if they're non-nationals or non-GCC nationals. And they also very often monitor the composition of the workforce as well in terms of nationalities and skill sets and so on. And the wages protection system is really a monitoring system. It applies to every employer who is registered with the Ministry of HR across the Federation, so across the 7 Emirates. Within Dubai, it also applies within 2 free zones. So the DMCC free zone and the Jebel Ali free zone have opted in to be part of the wages protection system as well. And what does the system mean? It means that the employer, who is the entity under which the individual is registered with the Ministry of HR or with the free zone, has to pay their employees at least once a month. And that payment should go through an authorized bank account in the UAE, or for unskilled laborers, an arrangement can be made with money exchanges whereby they receive their monthly salaries through the money exchange. For example, Al Fardan and the like. It applies across the Federation, as I was saying earlier. We do see a little bit of variation in terms of how far wages are monitored in the different Emirates. Generally speaking, the ministry will check that a payment has been made to every individual registered with it within a month in arrears. So for example, if you employ somebody in January, they are then expected to receive a payment through the system in February. And on a very simple level, that's how the system works. From time to time, there are more specific audits. There can be reconciliations by the WPS team in the ministry or in the free zone to actually go back and look at the registered contracts, then analyze the payments that are being made every month to see if they're aligned. Now, obviously, if you're paying somebody a bit more, that's never a problem. It's where you're paying them less or you're not paying them at all. And one of the things that came out of COVID is that the ministry does now have a mechanism where the employer and employee can sign what's called an addendum. It's in a set format. It's downloadable. You can type it up in a Tasheel Center and so on. But that enables you to then register with the authorities that someone might be on unpaid leave or for whatever reason is not receiving their salary on a monthly basis. So then it doesn't cause issues. There is also guidance. It's important to say that it is guidance. It is not actually law. That up to 20% of a workforce could be paid outside of WPS. That's really a sort of mechanism to, I suppose, assist employers, because there's a recognition that there will be people, and it's usually the sort of exception is granted because in the more skilled categories, there might be people here who are on assignment or secondment, who work for more than one entity and so on. And so the pay arrangement isn't as simple as just getting paid directly from their registered or sponsoring entity.
Okay, and I think the relevance for us is, as a result, when you read that word pay, it becomes evident that perhaps it wouldn't work at all in a situation where you were subject to these rules and unable to pay, and therefore you would have to make recharges. And so for those reasons, we conclude that it's probable the FTA intended for the concession to apply even when in situations where the visa facilitator has to pay or does pay, as long as the customer doesn't, as long as the customer bears the cost, if that makes sense. And then we spent a little bit of time, before this, thinking about what the difference would be where the manpower service provider or visa facilitator and the customer are in different parts of the Emirates, i.e. whether they're in a different emirate, whether they're in the free zone to the mainland. And what we realized was that whilst there is no specific VAT difference between those scenarios, there are in fact transfer pricing and also some legal differences, which we've attempted to summarize a little bit here. Hopefully Sarah won't be too offended by my attempts at summarizing the legal consequences. Malcolm, do you want to just quickly talk about some of the important bits on transfer pricing with these sorts of arrangements?
No, sure. Thanks, Justin. So corporate tax was introduced for accounting periods beginning on or after 1st of June 2023. And one important aspect of that corporate tax regime is the free zone regime. And for companies that qualify, the ability to apply a 0% corporate tax rate to its profits rather than the 9% headline rate. So there are a number of activities that can be deemed to be qualifying for free zone purposes. However, it's important to highlight the role of substance. So to be a qualifying free zone person, the free zone person must undertake what they call the core income generating activities that relate to that activity. So for example, a headquarter service or a distribution activity. And it must maintain adequate assets, qualified full-time employees, and incur adequate operating expenses. And even if it does outsource the activity to another person, and this can only take place to another free zone person or another designated zone person, it must still adequately control that activity. So what does that mean for this particular case study? And I'd like to focus more on sort of the mainland, where the visa is in the mainland and be provided to the customer in the free zone. So if this is the provision of manpower, then effectively there is a contract for services. And if we assume that all the arrangements of the free zone person have been contracted in this way, then effectively the free zone has outsourced the important activities, or what they call the SIGA. And even if the free zone person has retained some control, the fact that this is outsourced to a mainland company could restrict it from being a qualifying free zone person, except in certain IP cases. However, and this is the example on the right, for visa facilitation, on the basis that the rights and obligations of the employees are with the free zone person, and the role of the mainland company is limited to visa facilitator, and assuming all the other conditions in the free zone guide are met, we would assume that the free zone person could be seen as carrying out the core income generating activities. So whether you fall within manpower services or you're deemed to be a visa facilitator is actually really important from a free zone perspective. But equally important, I think, from a general arm's length TP perspective is ensuring all transactions are priced on an arm's length basis. An important starting position for transfer pricing is the legal arrangements, as well as where the employees making the important decisions in relation to risk are. And this is specifically set out in the UATP guidelines, and they have a 6-step risk framework. So in the example on the left, if the arrangement is viewed as a service, and if there is an adequate supervision of that manpower in the free zone, then there is a risk that that transaction could be recharacterized, all the profit and loss moved from the free zone into the manpower, into the mainland entity. So it's really important that there's alignment between the legal agreement and the substance of the arrangements. And what this means in practice is that all related party agreements are revisited in light of this VAT clarification, along with the UATP rules, the free zone rules, and of course prepared by a lawyer.
Thanks, Malcolm. And Sarah, anything you want to add apart from spotting the typo, walking in a mainland location, on the legal side that might be relevant, emirate to emirate working, mainland free zone?
It's summarized on the slide, but I think very briefly it's worth emphasizing, because many people, it gets lost, I think, in the day-to-day, and many employers themselves are not always alert to it. But going back to what I was saying earlier, visa employee registrations and sponsorship on the immigration side is employer specific. What that means is the person can only work for the entity that sponsored them. Now, in some circumstances, you could then have the secondment, which I suppose is where all these structures come into play. But there's also a little bit of limit from the immigration perspective on how far you can move people around, use them either in the same corporate group or second them to other entities, related or not. And that's to do with where the companies are registered. So if someone is on a mainland visa, by which I mean their visa is issued through the Ministry of HR, they can be seconded to any other entity that's also registered with the Ministry of HR, and they could be given what's called a temporary work permit. They could also go into the free zones. Most of the free zones have a mechanism where you can get what's called a non-sponsored person card, and that allows someone from the mainland to come into the free zone and work and sort of legitimately and lawfully work. The real, I suppose, difficulty or problem is where you've got someone on a free zone visa. So their employers in the free zone, their work permit is issued through there, their residency has come through that free zone authority. They cannot come onto the mainland and work for an employer that's registered with the Ministry of HR. The Ministry of HR does not recognize any kind of mechanism for allowing people from free zones to come onto their jurisdiction and work lawfully. So free zone to free zone is possible, mainland into free zone is possible, but free zone into mainland is where it's difficult. Technically, it's not supposed to happen. Now, obviously, people can attend business meetings, they can visit entities on the mainland, but they should not be working there. They should not be sitting behind a desk and working from 9 to 5.
Thank you. So some important issues there, I think. And then just quickly, I wanted to go through a couple of the conditions. If you're, the conditions can broadly be summarised as presented on the slide. And I wanted to talk a little bit about two of them specifically. We can take questions on the other items. But specifically, I wanted to talk a little bit about the corporate group test, where if this is not met, then you must charge VAT on the whole amount. But that then might be different from, for example, Malcolm's perspective, because it might still look like visa facilitation. And then also the condition that the facilitator's business activities don't include the supply of manpower. So in other words, this concession can't apply in certain circumstances. And the other two I will leave for any questions if people have got. I think they're mostly self-explanatory. On the no corporate group, so in other words, the intention of the FTA guidance is to only allow the salary to escape VAT where the visa facilitator and the customer are within the same corporate group. And what's interesting about how they've defined that is that they've actually used a much more generous interpretation of corporate group than perhaps they could have done. And perhaps part of the practical reason for that is that if you are a wholly controlled entity, you could be VAT grouped. And so obviously these rules do not apply in those circumstances, because if you're capable of being within a VAT group and are within a VAT group, then all of these charges are not subject to VAT at all, including the visa facilitation. So you don't even need to think about these rules. So that's an important, simple step that you can take to avoid thinking about this from a VAT point of view, just creating a larger VAT group. However, that may not always be possible because the VAT grouping criteria requires control. Whereas the rule that they've applied here is essentially the related party rule. And they're trying, I think, here to be a little bit more generous in their interpretation. But that does mean you've effectively got a series of different types of group that the tax authorities may refer to, a VAT group, and here a related party group. And then I will leave Malcolm to explain the corporate tax and transfer pricing type groups.
No, indeed, Justin. I mean, I think the key point here is that while the VAT grouping is quite broad, I think there could be instances where you might assume that you're part of a group for CT and TP purposes, but you could have a bit more sort of relaxation to fall within the VAT definition. And I think the analysis, the key point is just not to assume that if you're within a corporate tax group, that you're within, you'd also have a VAT group.
Yeah, and vice versa, I suppose. And then I think this is also important for employment law, Sarah, from recollection. There's a couple of situations where being within a group means more relaxed treatment. Is that right?
Yeah, that's right. So the authorities generally will recognise that if all the if the whole group is under common ownership, then they can use their employees as one pool of people and move them around. But the key is that it has to be 100% common ownership. So the same shareholders across the entire group.
Thank you. Thank you. So a little bit more restrictive, I would say. So that's the corporate grouping rules. And then the multiple entities service. And what we're trying to demonstrate here is the FTA have essentially said, if you are a manpower service provider, so if your business, which doesn't necessarily have to be your business license, but just what you do practically, includes the provision of manpower to other persons, then you can never be a visa facilitator, even for your corporate group members. And so that definitely would be the case if you were just a simple manpower provider to other people. But it could also be the case in situations where you coincidentally perhaps provide manpower. And so A&M might be an example of that, where it's not uncommon for us to second members of our staff to third parties and charge our clients on the basis of manpower services. And for those reasons, therefore, we may not ourselves be able to take advantage of this rule, because our entity may not be a visa facilitator simply because it provides manpower services to other people. I think the other thing to be wary of here is, even where your business doesn't generally include that, you need to be wary of situations where you may have a visa holder who's perhaps a very senior, who may work across all entities in the group. And perhaps you need to be very careful that that person therefore could not be seen to be under the control of any specific customer, and may in fact himself or herself control those other entities more, and therefore the manpower service provider isn't a visa facilitator and is therefore providing that member of staff on a normal basis, even if only one of the customers may pay for it. So just a few things to be sort of wary of. It may be possible to deal with some of this contractually, and I think some of Sarah's points make me realise that one of the problems with a lot of these arrangements is that they are not documented. And one of the things that you might want to think about is documenting things, making sure it's clear what people's roles are, and that will help you from a VAT point of view, but probably more importantly, from a visa immigration perspective, and also a transfer pricing and corporate tax perspective, to get the documents matching the reality. And that is where the risks lie, I think. And then finally, there's a little bit of discussion in the FTA guidance around what to do in situations where there is no charge made, for example, or where one of the parties, specifically the customer, can't recover its VAT. And there are two different rules that are being dealt with here. One is a deeming provision and one is a market valuation provision. And the deeming provision that the FTA are referring to is in the visa facilitation area. And it is essentially saying, if the visa facilitator incurs costs relating to the staff member, and remember the customer is probably paying the salary, but the visa facilitator is incurring the cost of obtaining the visa, the medical checks, etc. If it's incurring those costs and not making a charge to its customer for those costs, but is nonetheless deducting VAT on those costs, then it may well then be required to account for VAT on a deemed supply between the visa facilitator and the customer, which may not have happened in the past, but they are saying essentially if you've deducted the VAT, including associated VAT on overheads, actually, which is interesting, I thought, then there would be a deemed supply, the value of which would be based on the cost to the visa facilitator. So that's the deemed supply rule. There is then a further rule, which they don't specifically refer to in a great deal of detail for manpower services, but it applies to both manpower services and visa facilitation, which is that if the customer, even if you are making a charge, cannot recover all of its VAT, and if that customer is related to the visa facilitator, which it would be, of course, to meet the condition, or to the manpower service provider, which it may or may not be, depending on the other conditions, then the value of that supply must be the open market value of that supply. Now, I think there is an argument to be had or discussed as to what's the open market value of supplying a member of staff. I think that you could start from a position of saying that the open market value is the costs, the salary, because that's how much it costs to get that person. But as anyone will know, if you're seconding people or borrowing people, the market value actually increases. And so if you think about, again, if you use A&M as an example, obviously we wouldn't charge the pure cost for the borrowing of our staff, because we're bearing the risk of having those staff after you don't need them. And therefore there is a higher cost. So there is possibly a market valuation issue there. And I think this is another area where Malcolm will chip in around valuation. And I think the rules are very similar for the market value.
No, indeed. No, thanks, Justin. I think it's exactly that. I mean, in certain countries, there'll be a bit of a nuance between market value and arm's length. But I think for these purposes, they can be read quite similar. So in the case where manpower is provided, and this is to a related party, then the question becomes how to price the transaction. So once you've done the function analysis and you've determined that there was a benefit provided to the customer, you've got to run through the appropriate TP methods. And I won't run through all 5 of them, but I'll focus on the 2. So is there a comparable in the industry to price the transaction, what we call the comparable uncontrolled price method? Is in the A&M example, is A&M also providing a service to a third party, and then you can use that to benchmark against your transaction with A&M to its related party. But do note that method for TP requires a very high level of comparability than other methods. And if you can make reasonable adjustments, then they should. However, in many circumstances, there will be a revert to the transactional net margin method, and that effectively means cost plus for service. And then what cost should be included in the cost base. So typically we'd expect this to be the fully loaded costs of the services provided, the salaries, the benefits, the accommodation, the employer contributions, and any overheads. And this is an example where there is manpower services being provided. And what should the markup be? So the UAE guidelines do allow the use of the OECD's low value added service safe harbor, and they say 5%. That's the standard cost plus 5. But this only applies in certain circumstances where those services are support in nature and they're not core. And they rule out R&D, manufacturing, production, purchasing, sales, etc. So as such, I would anticipate that the safe harbor not to apply for many providers of manpower services, especially if that underlying service is core to the customer. And what that means is that you need to prepare a benchmarking study to support that markup. And if the manpower service provider provides a service to more than one related party, you need to have an appropriate allocation method. And this can be either a direct method, if you can track time, or an indirect method. And then finally, where the services are restricted to visa facilitation, this would include the cost of the visas and also the visa services themselves. The position could be taken for third-party visa costs, that this could be passed through at cost. However, for the visa facilitation service itself, if there are employees based in the visa facilitation company providing those services, their service is also should be charged for. That would be the fully loaded cost again, plus the relevant markup. And in this case, you're more likely to fall under the low value adding service category, as they could be deemed to be support in nature. And that's good news, because you could probably get away with applying 5% and not having to commission a separate benchmarking study.
Thank you, Malcolm. So just finishing off now, and we can take any questions if people have got any. Have we got questions at the moment? A couple, okay. So we may have a couple of questions which we can share and I'll try and answer. The first thing is, obviously you need to review the arrangements that you have in place. There's a specific point around checking the VAT position. I think also, though, at the same time, you should be considering the overall arrangements and thinking about whether you need to document some of them. I think that probably would be more important for transfer pricing and the legal position actually than VAT, but nonetheless helpful for VAT, especially around those kind of areas where an individual may actually, in practice, work on other entities in the organisation, and documenting in what capacity that person's doing it may mean that you're able to fall within the concession. Whereas if you haven't documented it properly, it may look like that person just works for multiple entities, for example. There's a separate point around determining whether the transactions have been priced and whether that's being accounted for correctly on deemed versus open market value versus consideration. which are all three ways of working out the VAT, but also from a transfer pricing perspective, which many of you will be doing anyway. And so I think there is some alignment of activity where you can probably save a little bit of time and effort if you do this at the same time. And also when you're doing your functional analysis, you can be looking at the free zone versus the mainland at the same time and rearranging visas, making sure things are documented properly, maybe even moving people around on different visas and basically regularizing the situation from a TP, VAT and legal perspective simultaneously. And yeah, spending a little bit of time considering and reflecting on some of the points that Sarah's made, particularly around the wage protection system, but also around inter-free zone and mainland working, and even actually between free zone to free zone specifically, but also documenting some of that. I noticed that Sarah made a point around, you know, a mainland person can work in a free zone, but they may need authorization from the free zone, and I suspect that isn't always done. So perhaps there can be some regularization done at the same time. Okay, so I will just quickly check the Q&A. Okay, so one of the questions is, and I'll paraphrase it a little bit, but is there scope to argue that the service from the visa issuer to the company should be categorized by the nature of the task performed? So in other words, is it too simplistic to say that it's just manpower services and it's subject to VAT? And so, for example, if it was medical services, could it be zero rated? Or if it was financial services, could it be exempted some way? And I think the answer is yes, absolutely. You could treat things differently because it's about the substance of what's being performed. And so I think there will be situations where it's a manpower service. And in those situations, one of the conditions you'll remember is that the customer is not directing the person. So in other words, that person is more independent and they are providing services. Yeah. And in the event that they are providing services, one must look at the nature of their services. And if those services therefore qualify for one of the exceptions, then I would agree that you wouldn't necessarily charge 5%. And I think the reason Malcolm's nodding is there's a similar point on transfer pricing, is that you'd be looking at the nature of their activity. Yeah. So that's a good point. And I think, yeah, there is scope to distinguish. And then there's a supplementary question about family-owned groups, and the question is, I'm going to make sure I've understood it. Can a family member be employed as a director of more than one company and have an employment contract and derive salary remuneration from all of those companies? And I think the answer to that would be yes, but you wouldn't necessarily fall within this concession, but you might fall within the special rules on the directors. If you remember, we had another clarification around that, but I would be concerned that you wouldn't look like you were being controlled, and in fact you would be controlling as a director, so you'd probably be better looking at those other rules.
Can I make one associate point on that question from a corporate tax perspective? So it's important that any payments to connected persons are on a arm's length basis to ensure you get the full corporate tax deduction in those companies. So you would need to make sure that the roles and responsibilities for that family member for each of the companies is in line with their job description and in line with what the market would expect that role to be performed. And finally, of course, there to be full evidence that those duties are actually being carried out. And then just the final point there is just to note from a free zone perspective, there can never be any double counting or substance. So if you are then relying on some of the exemptions from a free zone perspective, that's something to bear in mind.
Thanks, Malcolm. And then
sorry, I'll just say from an employment perspective, it's very common for in these family businesses for a family member to be, a director and an employee. It would be from an employment perspective, it would be very uncommon for those engagements to be replicated across a number of groups. Usually it's one entity that would employ that person, and then they could be a director of a number of entities within the group. And it's usually their remuneration is inclusive of any director fees for all the entities that they sit on from an employment perspective. You're on mute.
It was bound to happen, wasn't it? Yeah, so unless you can lip read, I'll repeat that. One of the other questions was, what if if there are other benefits provided to the employee as part of their employment contract that are provided by the customer in our diagrams, what happens with that? And I think the answer to that is all of those that are salary related, employment related benefits would benefit from the rule if all of the other conditions are met. So health insurance and other employment related benefits would all escape VAT in effect. And although I can't think what all those benefits would be apart from healthcare, but perhaps provision of a company car or values, those kind of things where they're legitimate for the business. And then we've got another question, which is, if the entity providing manpower to its parent company are part of the same group, then currently that's outside the scope. Will there be any change in VAT treatment as a result of this? And the answer to that is a very simple no. So FTA have actually said that this concession doesn't apply if you're in a VAT group. It was almost unnecessary for them to say this, because I would say if you're in a VAT group, it's always outside the scope. You don't need to think about this rule from a VAT point of view, but you still need to think about it from a TP point of view, and you still need to think about it from a legal point of view, but you can probably ignore it for VAT purposes, which is the beauty of having a VAT group. Okay. So I think I've got reasonably lightly there. We've run out of questions. So I hope that was useful. Anyone who wants to follow up or thinks anything was a little bit unclear, by all means, contact us directly. And we'd always be grateful for any feedback on today. I thank you for your participation and hope you have a good day.